Hello and welcome to S&P Global Ratings live webcast on the China corporate sector. I'm Brian. To begin with our webcast today, I would like to give you a quick overview of the web console that you're looking at right now. This webcast comes with audio and accompanying slide presentation. On your left is the Q&A box where you can submit questions at any time. You do not have to wait until the end of the speaker's remarks. On your right, you can download the presentation of today's webcast. Please help us to complete a short survey at the end of the webcast. We would love to hear your feedback. Please note that this presentation is not intended for and must not be distributed to retail clients in Australia. Joining us today in this webcast, we have Christopher Lee, Brian Zhang, and a moderator, Lawrence Liu. I'll now pass it on to Chris, who will kick off today's webcast.
Good afternoon, ladies and gentlemen. Today's topic is on the onshore bond defaults for China. What's next? So early in the year, when we were crafting our outlook for 2018, so we were struggling with the very strong financial performance of the corporate sector in the last 2 years, and a reasonably good outlook for 2018 in terms of earnings and forecast cash flow. But at the same time, we were troubled by the deleveraging campaign, especially the number of measures that have been pushed out towards the end of 2017, and the impact of those measures on refinancing and liquidity, considering that we have a wall of maturity that is coming in 2018 that will continue to escalate in 2019 and 2020. So if you're on page 2, this is the chart that we are looking. So borrowers are now climbing this maturity wall. In the first half, we're already seeing some casualties in terms of some companies failing to climb this wall as they face higher spreads and higher funding costs on page 3. So you can see how rapidly the spreads have widened as well as funding costs have increased. So we are looking at high yield funding costs are now approaching 10%. I mean, clearly this is an average number. Some single digit, some lower rated single B names, for example, are now paying up to low double digit for refinancing or for funding in the offshore market at a time when things are still remains quite unsettled. Those of us who follow this market very closely remember back in early 2010s or so, 13, 14, those were the days where we saw financing costs at double-digit rates. If you look at the page 4, one reason we are seeing this spike in terms of funding, higher funding cost is also because of defaults. So in the first half, we saw an increase in defaults that is matching the last peak in 2016 first half. A very different scenario here is the companies that have defaulted in the first half mostly are private companies as opposed to state-owned companies in first half 2016. The story here is really one of refinancing and a policy-driven deleveraging that is causing tightening of liquidity in the onshore system, leading to many highly leveraged and poorly managed financially borrowers to defaults, and most of these are in the private sector. So far, we see on page 4 the biggest defaulters are CEFC China Energy, a previously highly rated, domestically highly rated company that defaulted, as well as Windtime Energy. So far, this year, by far, the largest defaulter in the domestic market with $11 billion US dollars in debt. If we can go to page 6, this is the impact of the deleveraging we mentioned. So far, the credit growth, incremental social financing growth has slowed down quite dramatically in the first few months of this year. And this is very similar to what we witnessed in first half of 2016, coinciding also with that rise in defaults that I mentioned earlier. So in this year, what is notable is the contraction of the shadow banking funding sources. This includes entrustment loans, trust loans, the WMP type of funding, and the contraction of this part of the funding structure is impacting those companies that have depended on these sources of funding for expansion and also for refinancing. So typically these would be your companies in the property sectors, some lowly rated industrial companies, as well as local government funding vehicles. Now, despite the government's effort at injecting liquidity and easing the credit conditions onshore with new measures, for example, those measures that encourage banks to borrow the MLF to buy lower-rated corporate bonds, as well as liquidity injections earlier, triple R cuts, etc. The impact on lower-rated bond spreads have been limited. Clearly, some improvement has happened last Friday with that latest announcement from PBOC, but we think this may not be sustainable, looking at the broader picture where the liquidity injection is causing the renminbi to weaken. So if we look at the next page, and this is what we are, this is the main point for this report, which is the risk that puttable bonds are adding to the default risk in the domestic market. Puttable bonds are a big risk because we now have nearly 1 trillion of bonds, puttable bonds that could be put back to the issuers this year. This is nearly 3 times the amount in 2017. In the first half, that's only 1/4 of the amount outstanding could be puttable. Most of that amount is coming due in the second half. So 75% of this 1 trillion will be puttable back to issuers from July. So you could see that increase, and also in 2019 there's another increase. And why are we concerned about the puttable bonds is because these are structures mostly issued by lower-rated companies in the AA space. They comprise about 40% of the puttable bonds outstanding, as well as private companies. That's about 1/3 of the amount outstanding. And the risk here is, investors put back the bonds to the issuers, and the issuers are not able to refinance themselves. So if we just look at the puttable bond amount outstanding, 1 trillion, that's about 1/4 of the total amount of bond outstanding. So that's increasing the amount of maturity effectively by 25% if we assume all bonds are put back to the borrowers. So, and 2019 will be another difficult year in terms of the refinancing pressure, assuming the same amount of bonds are puttable. We also note perpetuals could be posing another kind of risk, another type of risk to issuers. These are issues based on the expectations that the issuers will call back, usually 3-year to 5-year, with a step up of between 300 to 500 basis points. Because of the very large step up, it is reasonable to assume that the issuers will call back the perpetuals. Now, if issuers don't call back in the currently difficult refinancing environment, it would send a signal that potentially their financial positions are weaker, although they may be able to absorb absorb the step up of 300 basis points, but that could have a significant impact in terms of their refinancing costs later on, meaning increasing their refinancing, the funding cost after the step up has happened. So that would, in the current environment where you have a large maturity wall, coupled with higher funding costs, could easily tip some of these issuers into distress. And on page 11, you can see them although a lot of these are highly rated SOEs, also quite a number of them are local government funding vehicles that depend on refinancing in the market to roll over that debt. So if they don't call the hybrid bond and this causes a spike in terms of the funding costs, then the question about how effective are they going to be in terms of managing the refinancing and securing the new financing in the bond market to meet debt repayment. So those are the 2 major points for this report, but we also like to make one last observation, which is about the profit outlook for state-owned enterprise. So far, the bond defaults have happened mostly concentrated in the private sector. These are highly leveraged companies. But also, we know that private companies' profit hasn't grown as quickly or as well compared with state-owned enterprises in the last 2 years. State-owned enterprises benefited from the supply-side reform, which boosted the commodity prices. Therefore, their earnings and cash flow improved significantly in the last 2 years. But we think this is coming to an end with the trade outlook now complicating a domestic environment where we have slowing credit growth, resulting in a decline in industrial activity and also investment activity. On page 13, it's This is a depiction of what we believe to be the forward-looking view of SOE profit growth, PPI minus CPI, so this measure really the midstream and upstream profit potential of SOE, and this is now pointing downward. And most of you who follow commodities very closely know that commodity prices already retraced back to their first half 2017 level, and if this trade war escalates, it would put a further dampener to the outlook of commodities. And commodities where such sectors where the SOEs are dominating. On page 14 and 15, this is a depiction of the LGFV proportion of the puttable bonds that are mature, that are callable on a monthly basis, as well as on the perpetual bond. And you'll notice here on the perpetual bond outstanding, a trillion renminbi outstanding, 1/3 of that is LGFVs. So in terms of rating transition, I would like to summarize up to the second quarter of 2018, the rating transitions still has been, I would say, fairly neutral with upgrades to downgrade ratio of matching. However, we're starting to see outlook transitions turning more negative following nearly a year of positive momentum here. So the outlook for the second half of the year, as well as going to 2019, is one that rating transitions are starting to turn slightly negative. At the lower end of the rating spectrum, we are now beginning to see many more companies being downgraded, as well as the outlook being put on a negative basis. So I'll stop here, and I'll open the floor to my colleague Ryan Zeng, who will give a few comments about the financial institution deleveraging.
Thanks, Chris. Today I'd like to just talk about 2 points. One is the deleveraging. One of the most asked questions we receive is whether there's a U-turn on the deleveraging. I'm just going to share our view to you from the FI perspective. And the other most received question is what are the areas that we are concerned with? So first of all, deleveraging. Many people see a lot of different news and signals out of the government in the recent time, like the past couple of days. Last weekend, there's a lot of news coming out, and people are reading this signal as potential U-turning or stopping of deleveraging efforts. From our point of view, it's more like an adjustment of pace rather than a outright U-turn of the trend. We believe the government policy is very clear. Many of these policies that come out in the past a week or so are pretty targeted. You can see which sector that they are trying to help and what sector they are continue to put pressure on. In short, we would expect to continue to see the deleveraging on in the overcapacity industry. Some of the weak companies that view as have very little future, they probably will continue to go through the consolidation. So that's on the deleveraging. And very quickly on the second point about what other areas that we are looking at. One of the areas, among others, is consumer credit. The growth of consumer credit. Apart from the residential mortgages, which has grown quite significantly, but I think the pace has slowed down. We have our eye on the credit card and the cash loan from the banking sector. And one of the concern we have is the speed of growth and the capacity. The sector's capacity to manage this fast-growing exposures. Just taking some example around the region, Korea, Taiwan, Hong Kong, they all had in the past faced some pressure on the consumer credit side after a period of fast growth. So that's all my presentation. Chris, back to you.
Thank you, speakers. For those of you who have missed the introduction earlier, please note that you can submit your questions via the Q&A box on your left. And over to you, Lawrence.
Thank you, Brian. So for the audience, we do have a poll question for you. I will give you 1 to 2 minutes to answer the poll questions, and then we will move on to the Q&A session. Okay, please do answer the questions. Now let's start with the first question. The first question is, the number of defaults has been increasing. Will the negative impact spread to other sectors, like the banking sector? Will the NPL continue to increase in the rest of the year? Is there a systematic risk in China? Maybe I will pass this question to Ryan first, and let's see whether Chris has anything to add.
Yeah, thanks, Lawrence. Yes, we do expect the overall pressure on NPL will continue. As the deleveraging effort continue, we can see more companies come under pressure. Having said that, though, we did in our recent commentaries point out that we expect some pretty different performance between the big banks and the smaller institutions. In recent time, I think when some of the smaller institutions, when they bring their wealth management product back onto their balance sheets, they experience some, shall I say, high pressure on their asset quality ratios, simply because some of these wealth management products quality are not that good. In the contrary, if you look at the large banks, while the large banks also bring their wealth management products back onto their balance sheets, the pressure on their NPL is a lot smaller. And I think there's also a reflection of the aggressiveness of growth in the past couple of years, and how these banks use wealth management products to manage their growth and their capitalization in the past few years. And now I think we are seeing the results. So again, to summarize the answer, we expect the NPL continue to come under pressure, but the large banks are likely to fare much better than the smaller institutions. Lawrence, back to you.
All right, thank you. This is another question also related to the one we just answered, right? So do you see that the Chinese government's tolerance for the situation of default in China? Maybe Chris, you wanted to pick this one?
Okay, I'll start, and maybe Ryan can add. So our view is the deleveraging campaign will continue. Despite the fine-tuning that Ryan has mentioned. It's a fine-tuning of pace and perhaps tactics, but the 3-year plan remains intact. Our view is that the condition for deleveraging remains favorable, with growth, at least in the first half, still running at above 6.5%. And there's also a lot of political capital tied up with this deleveraging campaign. It's the first year of the three-year campaign. So, a lot of measures could still catch up in the later on.
All right.
Ryan?
Thank you. Ryan, you have anything to add on this point?
Actually, not much. I think I fully agree with Chris that we do see the government has a higher level of tolerance on default, and banks are not shying away of putting pressure on the borrowers.
Yeah, maybe
all right, thank you.
Point, which is, the tolerance for default is also because I think there's awareness at the policymakers area level that the Chinese government cannot be bailing out all these entities that are running into trouble. We had tried $4 trillion of stimulus on nearly 10 years ago, and that has brought on many negative consequences, many of which we are dealing with today, including local government debt problem, LGFV's platform issues, as well as high asset prices in property.
Thank you, Chris. The next question is probably more specific to you. So this question is, can you elaborate a little bit more on the differences between the level of defaults we observed this year versus what we have observed in 2016? You mentioned very briefly in the presentation, but grateful if you can share a bit more on this.
What we are saying in terms of differences is that in 2016, the default was caused more by, number one, many years of deflation. PPI was negative, and the profitability of many companies was struggling, particularly those in the upstream sectors, commodities, energy. Two, there was a supply-side reform policy that was pushed out by the central government, and as a consequence, some of these defaulted entities were using this as a means to go for a debt restructuring and default on the debt. So that was a very specific environment where we see a very tough operating environment for upstream operators, companies, especially in midstream and upstream, and also a government policy that is trying to eliminate excess capacity in those coal mining and metals and mining sectors. Whereas this time around is different. The operating conditions are not bad for a lot of companies. In fact, last 2 years were really strong years in terms of financial performance, especially for upstream, midstream companies. What is different this time around is that the liquidity and conditions and credit conditions for weak borrowers are created by this deleveraging campaign. So that's the unintended consequences of the deleveraging campaign, and I think the policymakers, when they set on this path of implementing the deleveraging campaign, they know that it's not going to be painless. Therefore, they are willing to tolerate a certain amount of defaults. And so far, we are looking at proportion-wise amount of default that is fairly benign. We are looking at 0.2% of the total bond outstanding in the domestic market. So this compared to, for example, global defaults, EM, probably running around 2% average per year.
Thank you, Chris. So for those of you who had missed the introduction earlier, please know that you can submit your questions via the Q&A box on the left of your screen. Just along the same line on the deleveraging, right? So this question is probably also to Chris. So is there any quantitative targets for the deleveraging? What are the time frame we are talking about?
There is no quantitative target. As far as we know, that let's start with state-owned enterprises. So state-owned enterprises have been given targets to reduce their leverage. At the central level, it's a 3-year target. By the end of 2020, most central SOEs will have to reduce the average asset leverage ratio by 200 basis points. It's a modest target, but the fact that there's a clear metric and a clear time frame, it basically forces central SOE management to slow down the growth rates and to adjust their capital structure such that they can achieve that goal. So that is the only sort of quantitative target that I'm aware of for central for SOEs. There are no specific targets for the rest of the economy. I think the policymakers are well aware that a reduction or contraction of debt outstanding is deflationary, and it's not consistent with the view of a moderately high level of growth for the Chinese economy. So the idea is to slow down the growth, control the leverage level, and then in looking for other means to reduce leverage over time.
Okay, thank you, Chris. I think the next question is also to you. What is the total amount of bonds due to mature or putable, respectively, in the next 12 months or 2019? Just wanted to see how much bonds are puttable relative to the total maturity.
In 2019, next year, the total puttable amount will be 1.6 trillion, which is almost 40% of the normally mature amounts of bonds on onshore markets.
Thank you, Chang. Okay. There are a couple of questions on the the trade war between the U.S. and China. Maybe I can combine them into one, right? So what do you think that the trade war with the U.S. and whether that has any material impact on the financial profile for the Chinese corporate issuers? Maybe I pass this to Chris.
Yeah, so we have written extensively on this this year. So our conclusion so far is that the impact on the rated credit profile of corporates is fairly limited. We don't rate many exporters. Those that do supply chain, they are involved in the global supply chain might be affected much more. But generally speaking, SOEs, infrastructure utility companies, property developers, not directly impacted, although indirectly they would be impacted by weakening sentiment, investment demand, as we've seen. And I think these companies are more affected by the deleveraging, the credit tightening than the trade war.
Okay, thank you, Chris. This is a very specific question to the puttable bonds, right? So the company said that they let the bonds to be put as they do not want to pay more than 8% required by bondholders. But there are also news that the onshore borrowing is now over 10%, even for CFE and the Sino-Ocean. They'll both raised offshore corporate bond at 5 to 7%, which is this true? So maybe, Chris, do you have any insight on this one?
Chang will answer the question. Yeah.
Okay.
Yeah. Actually, I think for lower credit profile companies, they may accept higher coupon rates, like 8% or even 10%. So they expect the investors do not put the bonds back to them because it's very difficult for them to find a new funding for the bonds. So yeah, it depends on I think it depends on the credit profile of the issuers.
Okay, thank you, Chang. So there's one question from the investor is asking us whether this now time that it would be a bottom fishing opportunity for the foreign investors. I just want to say that we are not able to provide any investment advice. So maybe let's move on to the next question. The question is also related to the deleveraging, right? So this question is probably more specific to the SOE sectors. So are there any clearly highlighted penalties for non-compliance or deleveraging targets for SOEs? I figure maybe this is related to the target Chris mentioned earlier. Maybe whether Chris or Chang, you have any comment on this one?
Or maybe Lawrence, would you like to comment on this one? What are the penalties for non-compliance?
Right. I think I would say it's probably the central government actually put this has a top priority for the central SOEs to deleverage. When we talk to the SOEs recently, I think every company was talking about they are formulating various of plans to deleverage. I would say if there is any non-compliance, I think the consequence is likely that some of the senior members of the company could be removed from the post. So I think that's probably the non-compliance consequences. So maybe let's move on. So this question is asking our view on deleveraging in the property market. Do you expect defaults or over what time frame? Maybe I pass it to our corporate colleagues first.
Yeah, so we have already the first default in property sector this year, which is Wuzhou International, the wholesale trade center operator. It's a relatively small company. Prior to that, there were also news about companies, property developers that defaulted on trust loans, bank loans, and etc. So we are, again, the smaller companies, whether they are in property or non-property, other industrial sectors, are feeling the pinch of this tightening liquidity situation in the market. We do expect some of the weaker companies to face higher default risk. We have already started to take rating actions based on liquidity and refinancing risk for some of these names. So, you should, I don't have a full list. I can say that starting in the second quarter on, the rating transitions for property has already also moved to a more negative trajectory.
Okay, thank you, Chris. Let me remind the audience, for those of you who had missed the introduction earlier, please know that you can submit your questions via the Q&A box on the left of your screen. The next question I would like Ryan to answer. So this question is all off-balance sheet non-standard credit assets going to come to on-balance sheet, or some part of it will simply stop to exist, which brings down total social financing growth, like what we saw this year?
Yeah, I think the short answer is yes, we do expect some part of the non-standard credits will cease to exist. I think if you think of it, the stronger companies are the user of the bond market and the bank borrowing. And some of the weaker companies, when they find the funding a bit tight or they are not able to get to the bond market, they use some of these other channels to fund themselves. So I think it will be fair to say that the average credit quality of this part of the market probably is going to be a little bit weaker than some of the on average, some of the other channels. So under the deleveraging, some of these companies, especially the overcapacity in the overcapacity industry using this channel, they may find refinancing more and more difficult, even if they are willing to pay the extra price for it. However, as I mentioned earlier, there's a adjustment in pace. So they may have a little bit time to adjust, but in the long run, I do see some of these cease to exist.
Thank you, Ryan. We in our post question, we asked the audience what's their view on the LGFV's default. So actually, one of the investors actually asked this question back to us. So, what's our view on the LGFV debt and bond default probability? Is it higher than ever before or pretty much expected? So, Chris, you wanted to share your view on this one?
Yeah, I think the risk is increasing because we have policies that are that have been pretty aggressive towards the sector, trying to separate the platform's credit quality from their owners, the local government. That's one. It's been ongoing for a few years now, and most of the audience would appreciate that the rhetoric just hasn't died down. It's continued to ratchet up. Second point is the liquidity situation could turn for these platforms could turn less favorable. The bond swap program for the provinces, for the local government is coming to an end this year, by middle of the year. So a source of liquidity for LGFVs will be completed. And third is, given the tightening that we're seeing in credit conditions and refinancing in the domestic market, for those LGFVs that need to refinance themselves to repay debt, this is a challenging time, on top of that, we also highlighted the structure of the bond market, including the puttable and hybrids, that is adding more risk to this sector.
Thank you, Chris. For those of you who had missed the introductions earlier, please know that you can submit your questions via the Q&A box on the left of your screen. This one question on H&A Group, right? Any comments on H&A Group? Maybe I can just pick this up. We do not have a rating on H&A Group, but given that we have a few public ratings in EMEA region in the US on some of the entities H&A acquired in the past few years, we do maintain a credit estimate on H&A Group. Our credit estimate is in the CCC category back in late last year, early this year, really because of the company's very tight liquidity condition, and that credit estimate is still in the CCC category. All right, maybe a very last question. So, may I know what are the possible ways for SOE to find new funding? As a corporate colleagues, do you have any comments on this one?
For SOEs, funding is plentiful. State-owned banks like to lend to state-owned enterprises, and one of the direct results of liquidity injection by the central bank and easing of credit conditions is that the lending will go to SOEs, and the investors will prefer SOE bonds.
Thank you all, speakers and participants. We welcome your questions and feedback and invite you to complete our short survey after we conclude. The survey will only take a few seconds, and we appreciate your opinion. You are also welcome to email us or call us directly. A replay of today's webcast will be available a few hours later, and you will receive an email notification on that. And do watch out for our other upcoming webcasts and events. Thank you for participating, and goodbye.